Hello there, Adam Gower here, and oh my goodness, it has been a little while since I've recorded a podcast, and I am delighted to say that my first of 2023 is with Glenn Mueller, professor at Denver University and academic director at the Family Office Real Estate Institute. Now, Glenn is best known for his real estate market cycle report. It is absolutely fascinating. It updates it every quarter, and we are going to be going through Q4 from 2022 in today's episode. But Glenn has also taken up a position at the Family Office Real Estate Institute. So we're going to find out a little bit more about that as well. It's very interesting. He is a fabulous fellow. And by the way, if you are listening to this, I do recommend that you go to gowercrowd.com and watch the episode, because Glenn uses some slides and they are well worth seeing. And of course, while you are there at gowercrowd.com, if you have not already signed up to our newsletter, do go ahead and do that. It comes out every Wednesday. We cover the entire world of real estate syndication online, aka crowdfunding. We provide news on latest deals and industry news. It's really cool. People really love it. Don't miss out. It's all there at gowercrowd.com. Just click the subscribe button on the page. All right, so without further ado, welcoming Glenn Mueller, professor at Denver University, and we're going to find out about where the economy is right now, what stage of the market cycle, what asset classes are performing well, what's not performing well, what areas of the country are performing well, etc. It is a fascinating and timely conversation. Here he is, Glenn Mueller. Professor Glenn Mueller. Glenn, it's super good to see you again. The last time we met, well, we didn't really meet. It was all audio, and it's been a couple of years or more, 4 or 5 years ago. So it's an enormous pleasure to see you on the podcast. Thank you so much for joining me. Of course, we have to start. You are world renowned for the market cycle report. And of course, I've got to ask you, where are we? Here we are, March the 1st, actually.
Right. Here we are.
2023. Where are we in the market cycle?
Right. And if you will, let me go ahead and just do a quick screen share here so that you can see. And if it goes to slideshow here, which should be, can you see?
Yep, sure can.
Can you see it now? Great.
Yes.
Okay. So basically, just kind of quick background. So started this in the early 1990s. So I've been doing it a really long time, like 30 years. And the idea is that markets go through two types of cycles. They go through a physical cycle, which is demand and supply for real estate, which drives the occupancy rate and rent growth. So what I found as I did all this research was that real estate goes through cycles about every 17 years, which is almost like 2 economic cycles. And the occupancy level drives the rent growth. So we're going to talk about that first. Then we can talk about the financial cycle, which is basically capital flows driving prices. So what you see here is, where are we in the occupancy cycle on all the property types? And surprise, surprise, basically every one of them is in that green shaded area, which is the expansion phase of the cycle. In other words, occupancies are actually rising in most cases for hotels, regional malls. Retail is actually doing surprisingly well, and we'll talk about that in more detail. Industrial, of course, is at its peak because of the Amazon effect. Apartments are a little over the top for 2 reasons. Number one, we have been creating a whole bunch of new supply in apartments, and pick the market, and we just have thousands of units being added in many, many markets. That said, we are short 4 million housing units in the United States today, and especially with higher interest rates, people aren't able to buy. But when people right after COVID, the COVID lockdown was over, people flooded back into the marketplace, and apartment owners were able to raise rents on average 12% in 1 year across the U.S. And in the really hot markets like a Denver and Austin, over 20%. So all of a sudden, even apartments became unaffordable. So people were doubling up, which means two people getting one apartment instead of two people getting two apartments, or staying at home with their parents, that kind of thing. So that has kind of shrunk supply a little bit. And then, of course, the one real problem property type, of course, is still office. And you see downtown and suburban office I've got in the recession phase. Occupancies are going down there, very hard to rent suburban space right now. And downtown office in their recovery phase, in other words, they're both below their long-term average occupancy rate because people aren't coming back. And we're going to talk about those in a little bit more detail. So let me jump ahead, and here's office. What you see is I cover 54 markets around the country.
Oh, hang on a second. I didn't.
It didn't move?
No, I think I'm maybe on a different screen, Glenn.
Let me back up.
Sure. I am on the national property type cycle locations.
Right, and it's still there. Let me.
There you go. Just click that one. I bet that's it.
I need to.
Oh, hang on. No, it's my mouse. I was looking at my mouse.
Right. See if you move forward. And now I'm looking.
Yeah, we're actually on a different screen. I was actually looking at the.
Okay.
Yeah. So.
Okay. So now I'm on the office market cycle,
okay.
And what you see is 54 cities spread out across basically every single one of the 16 points on this graphic. Wow. And the reason for that is that it's really dependent upon how that market is doing. The really expensive high-end markets, San Francisco, Washington, D.C., Boston, L.A., Chicago, are all low in occupancy because they're a very expensive place to live. And when COVID hit, people could move any place they wanted. And a lot of them got up and left. Faster growing markets like Austin, Texas had been number one for a number of years with tech jobs. Denver, a hot market, et cetera, doing somewhat better and typically above their long-term average. But it's really, really market dependent. So what industries are driving that city, whether or not young people want to move there. So to me, office is the biggest jump ball we have going. Some people are coming back, some people aren't. Some people are leaving if they're told they have to come back. All kinds of things going on. As a matter of fact, a study that just came out in England a few days ago, they had 30 companies that decided to take a test and go to a 4-day work week.
Yeah, I saw that. It was really interesting. Right, everybody loved it.
Right. Better retention, better job satisfaction, better productivity, all kinds of great things that kind of drive for that. Well, that really means that the demand for office space is going down. And what is really valuable today is brand new space that's really nice and fun and open and everything else. So new space is leasing up, no problem. Older space, Class B space, and older space and suburban space, much, much harder. So office is the one property type where rents are going down, occupancies are coming down. One of the ways we look at that is the amount of sublease space. If you've got space you're not using, you can sublease it to somebody else, right? Mm-hmm. And that space, the amount of sublease space in the market has doubled in the past year. That means that when that lease comes due, the tenant's is not gonna release that space. They're gonna reduce, do something different. So,
and that's nationwide, is it, Glenn?
It is, and again, market by market. Some markets are doing better, some markets are doing worse. California, San Francisco, San Jose are just really hurting because of it.
Yeah, it's interesting because we have clients in some of these cities. I've been looking at this, and this chart that we're looking at of the Q4 market cycle, where is office, is exactly consistent with what we're hearing. Tampa, Miami on the expansion, high demand,
right?
Occupancy is going up. I mean, really incredible. In fact, I recorded a podcast with Larry Feldman.
Oh, sure.
Actually, one of our clients at Feldman Equities, and we call it a tale of two office markets because we're looking at LA and Portland. And then you've got these other markets in Florida, particularly. In fact, if you look at this chart, heavy concentration in Florida of these growth markets. Incredible.
Sunbelt markets are doing great. You know what? Actually, I'm going to go ahead and jump ahead, and hopefully this is going to move okay, because I've got my market cycle, which we're looking at here. Where are you?
So hang on. Now you've got to, if you click
what I'm going to do is jump ahead. I've actually got my forecasts in here as well.
Perfect.
So my forecast for the fourth quarter of this year is that a lot of markets end up in the recovery phase. They kind of bottom out and are starting to look like things might start to pick up a little bit, at the end of the fourth quarter here. So all those markets with the problems, are clustering at a pretty low occupancy rate. And of course, like you say, Florida markets, places like Las Vegas, are in the growth phase and look like they're going to do well.
So before we move from this chart, what is the data you're using to create these analyses?
Okay, so I have 30 plus years of historic occupancy levels, which is basically just the inverse of vacancy. And I model every city separately and then forecast out a couple of years to look at where that market looks like it's going to be moving. And, while there are many data sources out there, CoStar is one of the main data sources that has a very long-term history of what goes on. So, and the other thing is, in a recovery phase, you're getting negative rent growth normally. Obviously, in the expansion phase, you're getting above inflation rent growth. Once you peak and you're in the hypersupply phase, rent growth is still positive but slowing down, and then it goes back to either below inflation or negative in the recession section. So this just kind of gives you an idea about what to expect as far as rent growth going forward in those markets.
And in this expansion quadrant, top left, this green area, you've got these points actually across the chart that are numbered 1 through 16.
Correct.
And the number 8 is highlighted in green. It stands out. What does that stand for?
So that's a great question. Green is the cost feasible rent level, which means rents have to be high enough to make it feasible to build a new building. So really simple math. If it costs $400 a square foot to build a new building, and just as a round number, investors are looking for a 10% rate of return on that cost, 10% of 400. We need rents of $40 a square foot before you can cost justify building a new building. Okay, so developers, banks, everybody, looks at, what's the cost, what's the rent going to be, what are the expenses, and am I actually going to get a return out of this? So at that point, we start to see, real growth. Some developers say, well, I'm going to start my project now, and the forecast is I'll finish when I hit that green point, or I got the green light at 8 to get going, because it could take a couple of years to build an office building. Okay,
fascinating.
So let's move on then to industrial, and what you see is that the majority of all the markets are at their peak occupancy level across the U.S. At 0.11, which is the top of my cycle curve. And then there are a number of markets that are just over the top into the hypersupply phase. And again, at the peak, equilibrium, by the way, is where demand and supply are growing at the same rate. Okay. And that's peak occupancy. And right now we're talking about a 95% occupancy in industrial on average around the country. The demand has been off the charts, not only from Amazon, but every retailer out there now, to be competitive, has to be able to do online stuff. So and Amazon was chewing up so much of the space that they didn't leave, that there were retailers that couldn't even find space to rent, couldn't even get a developer to, hey, I'll pay you, I'll sign a lease now for something you're going to finish a year from now. Well, now that the economy has started to slow, and Amazon backed away from some of their properties, from some of the properties they were leasing, that all of a sudden there's some new properties coming online in those markets that are at 0.12 and 13, and their occupancies have dropped from like 95 to 93 or 92, which before would have been a phenomenal
Right.
rate anyway, right?
So it's all relative. So do you
Right.
think so is the implication of this that as we look at this, the industrial charts, absolutely nothing in recovery, nothing in recession, but
Right.
are a group of cities here, from Dallas, Denver, San Francisco,
Right.
and others, Salt Lake City and Austin, etc., that appear to be headed towards recession or some kind of imbalance. Is that inevitable, or they?
No, it's not. Possibly, yes, but at many times, and as a matter of fact, what you see on the chart here too, and I'll actually back up one to office for a second. You see numbers behind the chart, and what it does is it tells you if something moved from one place to another. So you can see a lot of markets move from 0.12 to 0.13 because they have a +1 after them. Sometimes you'll get a -1, and it really comes down to it really comes down to if the economy picks up, if we don't go into a recession, okay, and right now my model is based on the most macro average of economists, which is we probably go into a very mild recession in the second to third, fourth quarter of this year potentially, and so therefore demand slows down a little bit. Okay, and thus you see only a couple of markets there, San Francisco and Charlotte, having moved forward 1 point in the cycle chart. Many times, if I'm wrong, if the economists are wrong, and of course I run my model off of what they say, if the economy turns up, all those could move right back up. With a negative point back with -1 back up to that peak equilibrium. Right. And, around there is when you're getting your highest rent growth. Last year in industrial, we were getting 11% rent growth, which is really strong. And in all those markets that are at the peak, that probably continues. Okay. In other words, the demand is that high, and especially in markets like LA, Long Beach, etc., there is no space available. I just had one of my former students who's working with a group now. They buy brownfields, redevelop them, and then sell them to developers. They just took an old lime mine in LA and did all the environmental, cleaned it up, got it ready to go, sold it like immediately to one of my old companies, Prudential Real Estate Investors, and they are building 4 million square feet of industrial space on it, and it's all half that. And the day they also announced that they already had half of it, and it's 4 million square. 2 million is already pre-leased.
That's incredible, and that's LA,
right? That's how strong industrial is at this point. If we look at apartments, again, I'm expecting, and this is with the market slowing down, so many markets have seen really strong rent growth that has priced people out of even the rental market, right? And that's where, so now they're going to double up or move or stay home, move in with their parents, kind of thing. Right. And so all that new space that's coming online right now, which is all nice high-end Class A space, mostly in downtowns, they're having a harder time, and we're seeing them start to actually drop their rents. When you have Midwest markets that raised their rents last year 5%, they're probably going to get still a 2 or 3% rent growth. But when you had Denver going up 20, it's probably going to be down 5% next year. That's still 15% higher than the previous year, but so it's kind of an interesting and mixed bag there as to what's going on. You can see a lot of markets and the national average moving forward 1 point there to 0.13.
It is fascinating. This is a really fascinating chart. So we're looking at the apartment market cycle forecast for fourth quarter this year. And if I remember correctly, the office market, I'm looking at Tampa again, just because this is a market that I'm quite familiar with. The office market was undersupplied and moving towards that point where new construction at 0.8 was viable, and yet the apartment market appears to be predicted to be in recession. So how do you account for that imbalance? So you've got apartments going into recession, but offices ready to build.
Right, and the answer is it's either demand or supply, and in this case, the amount of supply is just going through the roof, and and brand new, really expensive stuff that's going to be hard to lease. So the occupancy rate is going to drop. And one of the things that happens, and I teach in my development class, a lot of students choose to build to do a deal on an apartment building. They go, historically, a brand new apartment will lease up in 12 months and be right to market occupancy level. So if the market's at 95%, I can pretty well guarantee you I can get any apartment up to 95%. They go, really, how? And I go, simple. If I'm not leasing fast enough, I just drop my rent to what a class B is and call people up and go, come on over here, being brand new for the same price, and they'll move. Right. So it's interesting to see. So apartments got a little more risk on it now than it used to. Okay.
Sure does, doesn't it?
Right. Retail, everybody thought that retail was the worst thing going for years and years because of Amazon, and we saw things closing, etc. Retail is now at the highest occupancy level in over 40 years worth of information.
This chart is newsworthy. All the other stuff is really interesting.
Right.
This thing is crazy. So just to describe what I'm looking at here, every other
what
chart,
we have is every market is at its highest occupancy rate. We're talking 92 to 95% on average for these markets. And the reasons are twofold. Number one, we haven't created, because of the problems with Amazon over the past number of years, we have literally slowed new construction in retail down substantially, number one. We have taken existing supply off the market and converted it to office, close-in industrial space, and or apartments, okay? And last year, 80% of new construction was pre-leased. In other words, you already had a tenant doing it. And when COVID hit, one of the things I did was said, look, you've got two types of retailers, the COVID haves and the COVID have-nots. If you were deemed essential and you could stay open, and home building, Home Depot, Lowe's got to stay open, Walmart got to stay open, grocery stores got to stay open, okay? Their sales went through the roof. And anytime a retailer has increased sales, that means we must be doing something right. Let's open more stores. Right? If you were non-essential, like clothing, you basically shut down. And so none of that is being built at the moment. And we're getting malls, reconfiguring themselves, having more experience type retail that the millennials are looking for, and that kind of thing. So it's complete, complete reversal.
Do you think that there is and the note that I wrote down here was COVID rebound. Everybody's stuck at home. And now after COVID, everyone, plus a lot of cash in the economy, people running out.
Yes. So as a matter of fact, let's talk about the COVID rebound contraction. Okay. So when COVID hit, everybody's at home, Amazon or online retail sales had grown from 8 to 9 to 10 to 11 to 12% of all retail sales, over that, 5-year period, right? COVID hits, sales go to 18%. Amazon went, oh, wow, we just increased everything by 50%. We need more space. And that's when they started leasing and going crazy, doing stuff. And then when everything reopened, it dropped back down to 12.5%, back to its old trajectory. And Amazon went, uh-oh, that wasn't a long-term trend. That was a cycle based purely on the COVID problem, which has now basically been solved.
Right.
So that's the reason for Amazon's major pullback on that type of stuff. They still are in many markets, still taking space and opening space where they weren't set up properly in their fulfillment, but they're kind of moving that way. So retail, a lot of people still think very risky, not a bad place to be. And then hotels, as you might guess, kind of the same thing. Hotels literally basically just
on fire, basically.
They basically literally were forced to shut down during COVID and then reopened. And we have, if you will, the COVID have and have nots, where if it was you could drive to it, it did extremely well. And I'll give you an example. I sit on a investment committee for a fund called Arden Group out of Philadelphia. Own a hotel on Long Island, an hour drive from New York. This is a $1,000 a night hotel, right? COVID hits, and a month after COVID hits, their slow time was, September, October, and early November, and then Thanksgiving through Christmas, they're 100% full.
Mm-hmm.
They were full their entire slow season.
Oh my
people could drive there, right?
Ah.
And then when airlines started traveling again, all of a sudden, so if you're resort, recreation, or drive-by on the highway, you are booming. You have raised your rates. Your occupancy level is high. If you were a conference hotel, you sucked wind for about a year, and now conferences are coming back, and those are looking up. But if you're a business hotel, business travel still hasn't fully come back.
This is a really cool chart. Can you remember? We're looking at a static view here. Again, this is Q4 23 estimate. But if you can cast your mind back, and I do want to move on to the Family Office Real Estate Institute as well in a second. So let's not linger too much on this. But I do want to know, did you notice a particularly fast movement from phase 4 recession for hotels back to this expansion phase? Was it unusual during COVID?
It came up, long-term history. It used to be that hotels needed about 64% average occupancy to break even, right? With all the new technology and things they could do to charge you for, et cetera, that dropped to 62. Pre-COVID in 2019, we were at the highest average occupancy ever seen at 72%. Okay. Now we're talking in a lot of these markets, 75 to 80%. Okay. But, as a matter of fact, New York, as an example, obviously gets a lot of tourists, right? And that has brought it back, but some of the business hotels are still sucking wind. So it's a very unique thing. You got the COVID have and the COVID have not business hotels that are trying to figure out what to do. So it's a very unique time. And, pricing right now, obviously with interest rates rising, we're seeing, deals that were put together stalling. I think we're going to see, obviously cap rates are going to, have started to rise. Some, they need to rise more, because when you could buy something and have just at a conference the other day, one guy was, pre-COVID, we're getting mortgages at 3.15 on our apartment buildings. And now we're talking, 5. So that means, that means about a 20% decrease in revenues to equity, which means about a 10% decrease in what we're willing to offer to buy the property for. So, so it's a unique time. I think we're going to see a 2023 be a year of very low transaction volume, because sellers still want to sell for what they thought they were going to get in 2019, and buyers are like, look at the reality.
Exactly.
Right? And no one knows how long this is going to, how long, if we're going to have a recession or not, number one, and if so, how long it's going to last.
Right. So, and it's actually, what's interesting is this is a manufactured recession, right?
Correct.
By increasing interest rates, it's slowing the economy down. It's the idea, pumping the brakes.
Right.
All right. So thank you so much for showing us these slides. I'd love to talk to you more about them. But I am interested, and I'm just trying to reduce my screen. There we go. I got you now. I'm really interested in what is the story with the Family Office Real Estate Institute. That was not on your resume, if I can use your CV last time. So what is it? What's it about? What's your role?
Sure. So wealthy families. As a matter of fact, for centuries, wealthy people own a lot of real estate. And in the US, back at the turn of the century in 1900 to 1950, almost, more than half people made their wealth in real estate. Okay. Today, now with tech boom and all these other things, it's down to like 10% of people are making, actually create their wealth through that. However, wealthy families, they made it that, we get people that, I just sold my company for $200 million. And now where do I invest it?
Mm-hmm.
And the answer is that the stock and bond market have been extremely volatile for the past 10 years, and bond interest rates have been extremely low. So, that safety isn't that much. So, guy named DJ Van Kiernan, actually, we met probably a decade ago, came and said, I'm working with families. They're interested in things. He does a survey of them every year. And one of the top 3 things they were interested in was education. We need to learn about real estate. Okay. There are many, many places where families can get together with other families to talk about everything from family dynamics to general investing, et cetera. But we're the only thing that looks at solely real estate. And so we're planning our 3rd real estate investing class for families in April. We did one online when COVID hit. We've done one on campus now, and we'll be doing another one in April in Denver. And very interesting, we put out a magazine, the Family Office Real Estate Magazine, or FORE, like in golf. And it's in its now 4th year of publication, which is great. Do the annual survey, and we're just starting the 4th annual survey now. And also putting on some summits and conferences where families can get together, meet each other, talk together, look at co-investing together. We, if you will, curate and bring in people that are interested in working with families and things like that. For instance, right now, I'm looking through all the information. A next generation Marriott family member has started a fund, and is looking for, and already, they're actually on fund 2 and looking at investing, in hotels, as they come available here now. So,
Glenn, what is it that you teach? Like, what is the curriculum?
Okay. It is understanding market cycles, being able to analyze a city and a property, being able to develop a portfolio of real estate, managing that portfolio of real estate, disposing of or upgrading over time, and then all the tax implications and legal implications. Most families historically, one generation makes the wealth. The second generation, about 70% of them burn it all up, and 90% of the wealth is gone by the 3rd generation. With real estate, you got a hard asset that's much less liquid, so it's harder for family members to burn through it. They're if you will, sort of, okay, we got this and it's earning a nice income, I guess we should just hang on to it, kind of thing. So it's an interesting way of looking at the fact that real estate helps in preservation of wealth.
Exactly right. Not just income, but also preservation.
Right.
And I did say that we were going to talk about REITs, but we could actually, let's just do that really quickly.
Okay, sure.
I know that you're an expert in REIT research.
Right.
Real estate investment trusts.
Right.
I've always thought about these as being more closely aligned with stocks and volatility of the markets. But what's the situation with REITs at the moment? Should I buy REITs? What should I be thinking?
Right. So REITs are basically publicly traded mutual funds that invest only in real estate properties. That's the easy way to describe them. And because it's real estate, it's a little different than an operating company, so it has to be analyzed a little differently. I started looking at REITs back in 1992 when I was working at a company called Alex Brown, and then we merged with Jones Lang LaSalle, and eventually moved on to another company called Legg Mason, where I ran the stock market research team, and I helped take 22 of these companies public over a number of years, and then worked on the non-traded side at a company called Black Creek Group as well. And I've been teaching a real estate capital markets and REIT class for almost 20 years. And just 2 years ago, if I can, I actually wrote a book.
I'm going to read it to you. Educated REIT Investing.
Right.
Wow, sweet.
Right. Published by Wiley, and it goes through the step-by-step of how to look at companies, figure it out, how to build a portfolio of them, and that kind of thing. So just like stocks, to me, the stock market is emotional in the short run, but should be logical in the long run. Okay. So when COVID hit, the stock market took a dive, and every publicly traded REIT took a dive as well. And then immediately, when they realized that Amazon was going to do well, the industrial REITs bounced right back, right? So you can look at the fundamentals of direct real estate, and kind of watch what's happening, number one, and then look at what's happening. And today, honestly, the publicly traded REITs are selling for below their liquidation value.
Is that crazy?
Net asset value. So today, if you said, okay, I got $100,000 I want to put into real estate today, what do I do? Say, don't buy a property because it's probably going to go down in value yet a little bit, but REITs are already trading below private market values, and they're going to be coming back. So I have, and so I teach this, and I've done it for a living for a long time. I felt, COVID hit, and at the end of 2021, I said, this feels like a tipping point, a turning point in the cycle. And I liquidated all of my publicly traded REIT holdings.
Oh my goodness.
I watched them drop by 40%, and then started to get back in.
Cool. So, all right, good. So why are you not on with all these this track record? You should be on an island on Hawaii in a hammock.
Yeah, except that I'm actually looking out at a beautiful view here in the Colorado mountains, and it's snowing, and I'm a fanatic snow skier in the winter. And then in the summer, I have a home on the lake near my grandkids, and I'm a competitive water skier. So, so I have my home on the water. It just happens to be fresh water, and I'm a very blessed man to be able to enjoy my passions.
Wonderful.
as well as work hard.
Let me ask you 3 rapid fire sign off questions before we finish. Is that all right?
Yeah.
I'm not surprising. These are not gotchas, and I probably asked you last time as well. I can't remember. It was so long ago. And it, maybe they've changed, but what are your daily habits? What daily habits do you have, Glenn, that keep you productive and active and successful in what you do?
Right. Well, I believe that a solid, stable person lives on a 4-legged stool, and the 4 legs of my stool are God, family, job, and something for yourself. Men's Bible study. I've been going for 40 years. Great group of guys. Most of my ski buddies are there. Family's next. My 3 sons and my 4 grandkids, love spending time with them, that kind of thing. Always worked hard, always told my employers I'm going to try and make every one of my kids' games when they have something going on. But I'll never miss a deadline. So I'm a type A personality. As a matter of fact, my wife says I'm a double A because I work hard and I play hard. And then you got to have something for yourself. And for me, in the wintertime, literally 6 o'clock in the morning, all the mountains report how much new snow. I'm on my phone checking that to see where I'm skiing today. So I'll go out and ski for 2-3 hours in the morning, and then, and then work hard into the evening, whatever. So I have a schedule that allows me to do that. I've already skied 45 days this year.
God, that's incredible. Have there been 45 days? Yes, there have, actually. I can think it's just March.
Right.
All right. So let me ask the second of the last 3 quick questions, or quick answers anyway. Hardest lesson learned in real estate? You've been in this business a long time. What's been the hardest lesson you've learned?
Don't let your ego get in the way of a project. You spend all this time trying to build or design something, and people are saying it's not going to work. And the 2 times that it's happened to me, I was too, this is my baby. I'm right. And my bank went, we don't really think this is going to work, and I lost money on it. So don't get emotionally involved. Be able to step back and be, objective.
My last question. With your family office, new role with family offices over that Four Dot Institute, what advice would you give, or do you give, to family offices looking at the commercial real estate markets today? And let's say somebody just, they sold out for 200 million and they're looking at the markets, wondering what to do. What advice?
Right. If you don't have depth in real estate at this point, find someone that does. Have an advisor. Markets are very local. Being in the wrong submarket or even on the wrong corner means potentially a project that doesn't work, right? So the information, the research, and the underwriting of any investment is an absolute key in real estate, and you can hire that expertise to do that if you don't want to do it yourself.
Professor Glenn Mueller, an enormous pleasure to actually meet you in person, kind of, these days for the first time. Thanks so much for joining me today.
Yeah, you're very welcome. Thank you.
All right, that was Glenn Mueller, professor at Denver University and academic director at the Family Office Real Estate Institute. Find out more about Glenn and the Institute at gowercrowd.com. Of course, while you're there, do sign up for the Gower Crowd newsletter. It's totally free. Just click the subscribe button top of your screen and you will start getting emails from me. You can always unsubscribe, of course, every Wednesday. That's it. Thank you. Glenn, what a pleasure to see you. Actually, we've spoken a couple of times on podcasts. Never actually met before, at least on a video. It was nice to see you, nice to meet you. And actually, we didn't talk about it on the podcast, but I am super impressed by your skiing and water skiing and all kinds of other hyperactivity that you have there. Gosh, I wish I could drum up the energy to do that. I do sit at my desk for significantly too long every single day. I should get up and do 3 hours of skiing every day or something anyway in the mornings, just like you do. Anyway, Glenn, it was a real pleasure to see you. Thanks so much. I look forward to following up with you, actually. We had a nice conversation afterwards. That's it. Oh, and of course, to you too, dear listener, thank you for joining us. I hope you found this as interesting as I did. Glenn's market cycle report is absolutely fascinating. It comes out every quarter. You've really got to check that out. Find out more there and how to do that at gowercrowd.com on the podcast page. That's all I have this week. Thank you so much. Wishing you well. And we'll see you next time. For now, this is Adam Gower signing off.